Imagine a poker table where one player wins every single round. He folds right before bad hands and goes all in right before perfect cards appear. At first, everyone assumes he is lucky. But after winning 10 times in a row, luck stops being a reasonable explanation. Either he paid off the dealer or he saw the deck ahead of time. Whatever the method, he had information nobody else had. Now replace that poker table with the stock market. That is insider trading. Insider trading happens when someone buys or sells stocks using information that has not been made public yet. Information that would significantly affect a company's stock price the moment it became known. It is like knowing a popular food chain is about to be exposed for a health scandal and selling your shares the day before the story breaks. Here is how it works. Ordinary investors read public news and make decisions based on available information. But certain well-connected individuals get access to information before anyone else. A chief executive officer discovers the company is about to announce record profits. A lawmaker learns new regulations will destroy a major industry. An executive finds out a competitor just suffered a catastrophic setback. Instead of keeping that information to themselves, they quietly tip off a friend or family member. That person buys or sells stock accordingly. When the news goes public and the market reacts, they walk away with enormous gains before anyone else even knew what was coming. While ordinary investors face serious legal consequences for far lesser offenses, the most powerful figures in the financial and political world continue making suspiciously well-timed trades. Several documented cases show politicians selling large stock positions in major companies shortly before damaging information became public. Others made purchases in defense and weapons manufacturing companies just days before major military conflicts were announced. Conflicts they had direct policy involvement in. Some of these individuals sat on committees with access to classified intelligence briefings and foreign policy decisions that directly moved financial markets. When the people writing policy also profit financially from the outcomes of that policy, the conflict of interest is impossible to ignore. Not everyone escapes consequences. One former government official was sentenced to 22 months in prison after purchasing shares ahead of a publicly unannounced corporate merger. When the deal was made public, the stock price surged and the gains were undeniable. The court rejected claims of coincidence and ruled it was a deliberate criminal act. But these cases are rare exceptions. The system has significant gaps. Elected officials are legally permitted to own and trade stocks in companies directly affected by legislation they vote on. Disclosure requirements exist, but carry minimal enforcement. Trades are sometimes filed late or hidden under a spouse's name. Oversight mechanisms frequently fail to produce meaningful consequences, even when timing appears deeply suspicious. For ordinary investors, the disadvantage is structural. By the time public information reaches retail traders, insiders have already acted. The market moves before most people even know what happened. Insider trading is not simply a financial crime. It is a fundamental betrayal of public trust. When those in positions of power use privileged access to enrich themselves at the expense of everyone else, the entire system loses credibility. This video is purely educational and satirical in nature. All examples are illustrative. Nothing here constitutes financial or legal advice.